Very good morning. Welcome to Chartbusters. Well, as we speak, things under pressure. Let's see whether or not a recovery is outside. The bulls at best will be hoping at least the 17,000 odd mark is defended. For the time being, things are looking quite grim. Hey, Mangala, morning.
Things are indeed grim, Nigel. And the broader markets, one look there and tells you the entire picture of the day. 15 stocks, so 16 stocks in the red for one in the green. We're at the low point of trade. Minor recoveries are getting sold into. So let's talk about all the top stories that we're tracking this Monday morning for you. It's a gap down start for the Indian market amid a sell-off in the globe. All sectoral indices open with wide losses led by realty, metals and autos. Banks too slide. The mid-cap index sees cuts of over 3.5%.
Britannia outperforms after announcing a management rejig. Varun Berry gets promoted to managing director. Rajneet Kohli, who previously headed Domino's and Jubilant Food, has been appointed as the CEO.
Crude below $90 a barrel, in fact around $85 a barrel, and as a result of which upstream companies like ONGC and Oil India slip almost 4%.
A strong debut in a weak market for Harsha Engineers, the company which is the largest manufacturer of precision cage bearings by revenue, listed at 35% premium to its issue price of around 330 rupees a share.
Power Grid is among the top F&O losers for the second straight session. The stock continues to decline on reports that the company will be asked to purchase PFC's 52% stake in REC. Brokerage house Jefferies fears that this transaction could hit the EPS by 3 to 5% were it to fructify.
Well, it's not looking good at all for the markets as we speak, because if you bought at any point of time, you would be in the red. Any kind of pullback is getting sold into. I guess the last glimmer of hope is the 200 DMA. That's at around that 16,990 odd. Shilpa Rao joins us. Hi, Shilpa. Well, the bears seem to be in control out of nowhere from 18,000. We're back towards 17,000 odd. What's the fresh trade at these levels? If you could give us a sense. And where do you see support coming in?
Good morning, Nigel. Nifty and Bank Nifty on daily trends, they have broken down the crucial supports. Now we are definitely heading towards 16,800 and 16,200 once we decisively start trading below 17,000. So 17,000 is a crucial psychological level as well as support. Likewise, Bank Nifty below 38,500, it goes into a free fall zone till targets of 36,000 as well. So this is how the setup is: very weak, very bearish. So staying cautious on longs is advisable.
Right, staying cautious on longs, and there is a big decline that we're seeing across the board. Barring a few FMCG names, everything is falling anywhere between 6 to 7% in the F&O pack, and even the non-F&O pack, we're seeing big cuts, sector agnostic cuts as well. So what are your trades, individual stock trades for today, Shilpa?
I have one, actually a buy as well. Lalpath Lab, if you see, even on Friday, such choppy markets, today such choppy markets, it is giving a sort of a breakout above 2,500. It is holding well. So one should go here long. It is trading at 2540 now to 2,540. So stop loss of 2,500 zones. One should see targets of 2,650 to 2,700. So that is a buy. And another one would be a sell in AU Bank. It has just broken down below 600 levels. So one can see targets of 550 in coming days. For intraday traders or maybe a couple of day sessions trade, one can also go for 590 put contracts trading at 8.5 or 9 now. We've also generated the same call in PL today. So that is one call one can take with a stop loss of 6 and targets of 13 and then 80.
Take that point, Shilpa. Thank you so much for joining in and giving us your views. We have a sell call on AU Finance as well as a buy call on Dr. Lalpath Labs. Let's shift into our special segment where we get you a few ideas for profit coming in from our colleagues at Money Control Pro. Anubhav Sahu joins in with a stock that he's been tracking.
Now, with the backdrop of European energy crisis, one of the stock to watch is Clean Science and Technology. Now, this stock has been a preferred name in specialty chemicals domain for us due to its dominance in some of the performance chemicals. Now, key strength is the success in process innovation and green chemistry, which helps it to garner better yields and margins. Further reduced supplies from its peers, BASF and Solvay on account of energy crisis also puts it in a better position. However, what concerns us is the geographical contribution from Europe. Though direct sales from Europe is about 15 to 20%, indirect exposure through clients in emerging market are much higher. Now, we believe demand slowdown in Europe is a defining factor for near term. Further, as the bulk of end markets are discretionary in nature, impact could be relatively higher. Now, in recent times, company has also been reluctant in pass-through of input cost. Having said that, our medium-term key watch is commercialization of HALS series product, for which they compete with BASF. Another development is the entry of Vinity Organics as a competitor for its flagship product. Overall, short-term challenges and valuation are concerning. Stock is trading at an EV by EBITDA of 40 times fiscal year 24 estimates, which leaves limited margin for safety, and hence investors can take some profit off the table.
Thanks a lot for that. Anubhav, well, for the time being, though, we'll slip into a short break. When you come back, well, there's a new kid on the block. Harsha Engineers, well, they listed earlier.
Welcome back. In an otherwise bleak market, it's a strong listing that we're seeing for precision cage manufacturers, Harsha Engineering. We have Vishal Rangwala, Harsha Engineers Limited, that is the company. It's up almost 43%. The issue price was 330. We do have with us the CEO, Vishal Rangwala, joining in. Vishal, thank you so much for joining in. It's been a strong listing, but now the street wants to know what next from here on. You know, the last time you joined us, you said that at peak, your revenue could be close to around 2,000 odd crores. Just wanted to understand by when do you intend to get to that mark? What's the glide path there? And at that part, you know, you would see some benefits of operating leverage coming in as well. So what would the margins be at those levels?
So I'm not able to exactly share the margin numbers, but we are confident of growing this margin, taking it forward. We are expanding our product portfolio, also getting into larger size cages. So all in all, very confident of you know, hitting that number, including taking advantage of some operating margins.
So by when do you hit that number? And when you say operating margins will you know, improve, I mean, if you could give us a sense of a ballpark, say what kind of operating leverage benefits would you see? Would it be 100 basis points, 200 basis points, 300 basis points, given all these things that you're doing?
Quite difficult to exactly answer that question. However, you know, last year we have seen a lot of difficult situation on the energy cost in Europe and etc. So even improvement on those, ability to pass on those to our customer, that will also support expanding these margins.
Okay, all right. Hi, Vishal. You know, the street will be very, very happy today because of your listing. Very few stocks are in the green, and your stock is one of that. But that's where things get challenging, right, from a listed company perspective. So let's understand a couple of numbers. FY23, what kind of a revenue growth can you guide for? Last year you did around 1,300 crores. With your current capacity, you can do around 1,800 crores. That's pre the capex. Then you move to around 2,000 crores. So for this year, what kind of a growth are you looking at? Give us a broad number. And also on the margin trajectory, you're in that vicinity of around 14 to around 14.5%. Will you stick to that band, or is there a bit of a tailwind coming in? Input costs cooling off, operating leverage playing out?
On the margin front, definitely both of those. There is a tailwind. There is a lot of products we have developed which are coming online. Also, as I mentioned, that, you know, there were energy challenges. We were now able to pass on those. So we are confident of growing margins. On the top line, again, we are confident of, you know, exceeding the industry growth based on the fact that, you know, our product portfolio is very strong. We are working on a lot of outsourcing of further outsourcing of cages, and we see that the whole you know, China plus one strategy, how it plays out,
yes,
will also Vishal, benefit us in a significant way.
You know, Vishal, before you list, we give you that bit of a leeway and we let you go without numbers. Now both the regulators and us as well, we want a couple of numbers. So we could turn it around. How much is the industry going to grow by, and at what pace will you grow if you're going to outgrow? 1.1, 1.2, 1.3, 1.4 times. Give us a revenue number. Let's focus on that first.
Right. So as I mentioned, there are a lot of factors going into that.
We get that.
Industry,
we get that,
but is going to grow 6 to 8% growth.
Okay.
And again, as I mentioned, that because of China Plus One and outsourcing, quite confident that we can hit the teen numbers.
Okay.
Again, difficult to put in an exact number.
No, teen is good. Teen is good. I mean, you've given us a ballpark. Teens could be anywhere between 13 to 16. If you're looking at mid-teens, that is low teens and mid-teens, that is something that the street will, pencil in as well as far as the growth is concerned. Just wanted to understand, roughly 40% of your revenues comes in from Europe. 65% is exports. Are you facing any issues there? Because, I mean, on the one hand, exporting should benefit you on account of weaker rupee, but we haven't weakened as against the European currencies out there. We've weakened against the dollar. So how does that work for you, and what's your hedging policy?
So one, you're correct that Europe is a significant chunk of market for us. However, a big chunk of or large chunk of that European market for us is manufactured in Europe, and another chunk is going from India. We are seeing long-term a very positive growth. We have not seen any short-term impacts yet, but this is a developing situation in Europe. So, I mean, in general, confident that we will continue to grow within Europe as well and overall. On the hedging front, we try to protect our cost. That's our objective. So we do a little bit of forward and focus on short term and try to pass on if there is a long term impact. Work with our customer on passing on those.
All right, we got the top line brief number. Teens is what you're going to be growing at, and that's a rather large range, but we'll take it at that. What about margins? 14.5% in the near term. Will it hold on, or do you believe you can go to the mid-teens? That's more than 15%. So that's point number one. And I believe you're the second largest player, right? What's the difference between you and the largest player? And has that been narrowing over the last few years?
Definitely, it has been narrowing. The largest competition we have is a Japan-based company called NKC, and they are about 1.5 times our size, but we are very unique in a sense that we deliver product bearing cages specifically in brass, steel, and polymer material, whereas our competition focuses on one or two of those materials. So with our strong portfolio, we are catching up to them, confident of reaching a good or reducing that gap further.
Okay.
And on the margin front, our India base, if you look at standalone, we are very strong margins, and a lot of growth is happening in India. So just by that virtue, we will definitely further grow margins as well.
You're being a little cagey yet again. Will it be a 15% margin? Should we be working with that for this year?
See, I understand. I'll not be able to share specifics.
All right.
Right. We take that point, Vishal. Okay, let's talk about a couple of other things as well. Just wanted to understand typically what is the working capital cycle for players like you, because I see, last year your operating cash flow was just around 37 crores versus an EBITDA of 170 crores. A large part of that was on account of high inventory buildup. Has that liquidated? What is the inventory cycle, working capital cycle that you guys work on?
So, we operate multiple warehouses very near to our customer across the globe. 25 plus, countries we maintain the warehouse. So yes, there is a significant inventory requirement to support that. Part of this was because, the growth was coming and we had to build the inventory up front. So we have done that work last year.
Okay.
And that's part of the reason. Another aspect of last year challenges were related to a lot of raw material supply side issues. So we were building inventory to make sure that we don't impact our customers. So all in all, we are on a little bit higher side, and we are hopeful that we can work to improve this going forward.
So a two-part follow-up on that, Vishal. The first one is that you said you are front-loading your inventory for growth, and secondly, you said there were raw material challenges as well. So the two parts are, one, what will your working capital cycle be for this year? And secondly, now that you front-loaded your inventory, you don't need any working capital. You've repaid your debt with the money, or you will be repaying your debt with the money that you get from the IPO proceeds. Your balance sheet should look relatively debt-free and net cash for the next couple of years. What's the sense? When is the next round of debt raising, if at all you have to do?
We don't expect to do, debt raising anytime soon. We have investment plans to support our, customers' growth and in line with that. So next 2 years, we don't expect to raise significant debt. We will probably work with some working capital if there are, relatively cheaper side because we do a lot of exports and we get a lot of those opportunities. But beyond that, we don't expect to raise significant debt.
Working capital days?
We target about 110 days of complete end-to-end cycle for us.
All right. And final question then, your interest savings...
We were a little bit higher last year.
Okay. All right. 110 days, we take that. And your interest savings will be 12 crores, right, on the repayment that you're making?
Correct.
And so
approximately that, a little bit higher.
Solar business does around 80 to around 100 crores in this year, FY23?
That's the expectation, correct.
It's been good speaking to you, Vishal. Your shareholders are quite excited, I think, with the issue. Next time around, hope you could give us a few more numbers, but you're giving us a broad sense. You'll outpace the market growth. Your margins will hold steady. There are a couple of levers as well. You'll be debt-free. Working capital days come down to around 110 days odd. Congratulations on a solid listing, and we look forward to speaking to you rather soon.
Thank you.
That's the big listing. Well, Harsha Engineers International, solid listing gains out there. The premium out there in the grey market as well was quite... Well, it's risk-off that's playing out today on the Lal Street. In fact, one of the big losers is Hindalco. Jefferies has come out with a note. They have retained a hold rating with a target price of around 390 rupees per share. Valuation-wise, they say the stock is trading at around 0.9 to around 1 time odd. And on a 10-year average, it's traded at around 0.8 times. When in the peak of crisis in the past, it's even traded at half a times also. Valuation-wise, they believe it's not yet very, very cheap. They highlight two factors. One is the slowing can demand and also falling aluminium prices. Both those two factors could hurt their businesses. For the can demand, it's going to hurt the Novelis LRS part of the business, and aluminium prices was directly correlated to the domestic business. First, on the can business, Ball Corporation, that's one of the leading beverage makers out there. It's one of Novelis's largest customers. Now, they had shut down some of their capacities in early September. And Jefferies, in a note as well, had said that they're a little bit skittish because of that. Now, Ball has gone ahead and they've lowered their 5-year volume CAGR outlook by a couple of percentage points. In North America, from around 4 to 6%, they've lowered it to around 2 to 4%. South America, they were earlier guiding for around 5 to 8%. Now they've lowered it to around 4 to around 7%. So that's about, the can business getting into a bit of a dizzy. The other factor is the aluminium business. Remember, aluminium prices have seen a sharp downtick. And they are anticipating that the EBITDA per ton of the aluminium business, that's alumina and aluminium put it together, in the past quarter, it was more than $1,300 per ton. They are factoring in the next couple of years, it falls to around $730 to around $790 per ton. So that's a large decline that they have factored in. They had come out with a note earlier in September and they had given a heads up that yes, they're cautious because of these factors. And it appears, at least as of now, things are playing out in that manner itself.
All right, Nigel, so that's about Hindalco. But meanwhile, we do have a couple of other stocks which are buzzing around as well. IT could be one of them. But what we'll do is actually take a short break, come back. All right. Vivek is joining us to tell us a little about Power Grid as well. Vivek, second day running, we're seeing a big cut on that stock.
Well, absolutely right. Friday, the stock fell on very large volumes, very high volumes. In fact, volumes were almost 4 to 5 times the typical 5-day average. And in fact, even today, the fall continues. Now, what's actually happened is that the stock as well as, market as well as brokerages have actually reacted to a couple of news reports that have come up that state that the power minister is in talks with Power Grid to purchase PFC's over 52% stake as far as REC is concerned. At this point of time, it is very important to note that neither the power minister, neither the power ministry, REC, PFC or Power Grid have given any official comments on the same. So we are still awaiting clarity on that front. Now, what's actually happened is that Jefferies has done a scenario analysis if this particular development does come to fruition. So what Jefferies is saying is that so far other PSUs have made investments outside on ministry directives. But when you're talking about Power Grid has remained relatively insulated, and which is why there were never any capital allocation concerns as far as Power Grid is concerned. Now, what they're saying is that if this particular deal does happen, they're saying that the dividend yield could be significantly lower at 4% versus 6% in FY23 that they had earlier estimated. Now, also what they're saying is that this is a near-term dampener for sure and could negatively impact the EPS by 3 to 5%. Also, what they're saying is that the multiple that the stock is currently enjoying could also get negatively impacted, and which is why Jefferies believes that this particular development could be a near-term overhang leading to a cut as far as valuation multiples are concerned.
Bye for clarity from many of those parties. Vivek, thanks so much for joining and filling us in with those details. For the time being, we'll wrap up on Chartbusters. Stay with us. Trading Hour comes up next.